The IRS does not care about your excuses. They care about your documentation. If your U.S. limited liability company is audited tomorrow, do you have the proof to survive? Or will you be writing a check for back taxes and a 20% negligence penalty? The IRS is currently ramping up enforcement of small business returns. They are using data analytics to find anomalies. You might be flagging yourself right now without even knowing it. Most business owners panic when they receive an audit letter. They scramble to find receipts. They try to reconstruct calendars from 3 years ago. It is a nightmare. But there's one specific documentation strategy that stops an auditor in their tracks. It is a method used by the top 1% of tax professionals. I will reveal exactly what that is at the end of this video. But first, you need to stop making the 3 fatal mistakes that trigger the audit in the first place. Mistake number 1 is the most common. It is also the easiest for an auditor to prove. It is called commingling funds. This sounds technical, but it is simple. It means you're treating your business bank account like a personal piggy bank. You use the company debit card for groceries. You pay for your personal Netflix subscription with business funds. You transfer money to your personal account without labeling it as a distribution or a salary. You might think this is harmless. You might think, I am the owner, it is all my money anyway. The IRS disagrees. When you commingle funds, you destroy the practical separation between you and your company. In extreme cases, courts can pierce the corporate veil and treat you and the LLC as the same person. For tax purposes, commingling also makes it much easier for the IRS to deny deductions and argue that you don't run a real business. An auditor looks at your bank statements. They see a charge for a steak dinner on a Saturday night. They know a gas charge is near your home on a Sunday. They see a transfer to your personal account to pay your mortgage. If you cannot prove these are business expenses, the auditor disallows them. Your business deductions disappear, your taxable income goes up, you owe back taxes, you owe interest, and you owe penalties. But it gets darker. If the auditor sees enough personal spending, they might argue that your activity is not a real business at all. They might classify it as a hobby. In a hobby classification, you generally cannot deduct expenses in excess of income. In many cases, that means you effectively pay tax on all the revenue with no practical deductions. All those business expenses you took for the last 3 years, gone. Here is the rule. Do not pay personal bills with your business account, ever. Transfer the money to your personal account first. Label it properly as an owner's draw or salary, depending on how your LLC is taxed. Then pay the bill from your personal account. It is a simple step. Failing to do it is expensive. This first mistake is about sloppiness. But mistake number 2 is about greed. It is even more dangerous because it triggers the IRS computer systems before a human even looks at your return. Pay attention, because this next one triggers an automatic audit flag. Mistake number 2 is claiming grossly inflated deductions relative to your income. The IRS uses a system called the Discriminant Inventory Function, or DIF Score. This is a secret algorithm. It scores every tax return filed in the United States. It compares your tax return to the industry averages. They know precisely what a marketing consultant in Chicago usually spends on travel. They know what a landscaper in Florida spends on equipment. They know what a typical online coach, Uber driver, or cleaning company spends compared to their revenue. If you report $100,000 in revenue, but you claim $80,000 in travel expenses, the computer notices. That is a statistical outlier. It screams for an investigation. The algorithm flags your return for review. An agent pulls your file. They want to see why your expenses are so high. Common triggers here are the lifestyle deductions. The biggest offender is the home office deduction. Many people claim 100% of their home internet. They claim a considerable portion of their rent or mortgage. But the rules are strict. The space must be used exclusively and regularly for business. If your home office has a guest bed, it is not exclusive. If your kids play video games on your office computer, it is not exclusive to them. The auditor will ask for photos. They might even visit. If you fail the exclusivity test, the deduction is denied. Another major trigger in this category is the vehicle deduction. You claim you used your luxury SUV 100% for business. You claim you drove 20,000 miles and not a single mile was personal. The IRS knows this is statistically unlikely. Do you have another car? If not, how did you get groceries? How did you go to the doctor? If you claim 100% business use on a single vehicle, you are inviting scrutiny. Meals are also high risk. Most entertainment is no longer deductible at all. Business meals are deductible only if they are ordinary and necessary and adequately documented. You cannot deduct a lavish dinner just because you talked about work for 5 minutes. The expense must be ordinary and necessary for your trade or business. Ordinary means common in your industry. Necessary means helpful and appropriate. A $5,000 trip to Las Vegas for a board meeting when you are a single-member LLC is suspicious. If you cannot prove the business intent, you lose the deduction. The DIF score is watching your ratios. If your net profit is 0 year after year, that is a red flag. If your expenses are 90% of your revenue every single year, that is a red flag. You need to be aggressive to save taxes, yes, but you must be realistic. Pigs get fat, hogs get slaughtered. Do not be a hog. And if this is already opening your eyes, hit the like button so YouTube shows this to more small business owners who need to hear it. These first 2 mistakes are about how you spend and report money. But mistake number 3 is different. It is about matching, it is a data problem, and it is the #1 reason automated notices are sent out. Mistake number 3 is reporting income that does not match IRS records. The IRS receives information about you from third parties. Banks send Form 1099 INT. Payment processors like PayPal, Stripe, and Amazon send Form 1099K. Clients who paid you more than $600 send Form 1099 NEC. The IRS computers take all these forms and sum them up. They know the minimum amount of income you earned. If your tax return reports less than that total, you are very likely to get a letter. It is automatic. It is called a CP2000 notice. It says, "We propose a change to your tax return." This often happens to LLC owners with multiple income streams. You forgot about that one consulting gig in February. You may not have downloaded the 1099 from that old Upwork account. You file your return based on your bank deposits. But the 1099s say you made more. The IRS trusts the 1099s. They assume the third party is correct and you are wrong. This gets even more complicated with Form 1099K. Payment processors report the gross amount of transactions. They do not deduct the fees. They do not deduct the refunds you issued. If you sold $10,000 of goods but had $2,000 in refunds, the 1099K says $10,000. If you report $8,000 on your revenue line, the IRS computer sees a mismatch. It thinks you are underreporting income. You must report the gross amount as shown on the 1099K. Then, you deduct the refunds and fees as expenses. The math is the same for your net income, but the reporting is different. It keeps the IRS computer happy. Another mismatch trap is the account name. If your LLC is a disregarded entity, the IRS looks for your Social Security number. If you opened a bank account with your EIN, but the bank reports to the IRS under your SSN or vice versa, wires get crossed. The IRS shows income for the EIN, but no tax return is associated with it. They see a personal return for the SSN with no income. Confusion triggers audits. Ensure the W-9 forms you give to clients match exactly how you file your taxes. The legal name, the tax ID number, and the classification all need to line up. So we have commingling funds, we have greedy deductions that trigger the DIF score, and we have income mismatches. Avoiding these 3 keeps you off the radar most of the time. But sometimes you get audited anyway. Random audits happen, and if you are selected, you need armor. This brings me back to the solution I promised at the beginning, the specific documentation strategy that saves you. It is called the Contemporaneous Narrative Log. Most people keep receipts. A receipt is just a piece of paper with a number on it. A receipt from Starbucks proves you spent $5. It does not prove why. It does not establish a business purpose. During an audit, the IRS agent asks, "Who was this coffee with? What did you discuss? How did this generate revenue?" If your answer is, "I do not remember, it was 3 years ago," you lose. The deduction is denied. The Contemporaneous Narrative Log solves this. Contemporaneous means you write it down when it happens. Not 3 years later. Not when the audit letter arrives, when the transaction occurs. Narrative means you tell the story. You do not just save the receipt, you write a note on the back. Or you use an app, you record 4 things. Who? Meeting with potential client John Smith. What? Coffee and strategy session. Where? Starbucks on Main Street. Why? To discuss the Q4 marketing contract. This takes 30 seconds, but in an audit, it is gold. IRS rules and court cases give much more weight to contemporaneous records than to vague memories years later. If you present a log that was created at the time of the expense, the burden of proof effectively shifts. It is tough for an auditor to argue with a detailed, dated log. It shows you are a professional. It shows you run a tight ship. Auditors are human. If they see disorganized records, they dig deeper. They know they will find mistakes. If they see a pristine, organized narrative log, they back off. They know you are prepared. They know they will not find easy money. Start doing this today. Do not wait for tax season. Build your defense file week by week. Protecting your wealth is an active process. The tax code is a minefield. One wrong step can cost you thousands in fines and legal fees. You need to stay ahead of the changes. You need to know the new laws before they take effect. I monitor the IRS and tax developments so you do not have to. I break down the complex tax codes into simple, actionable steps for business owners. If you want to keep your hard-earned money and stay out of trouble, you need to be here for the next update. Subscribe to Tax and Borders right now. Turn on the notifications so you do not miss the following change that could save you thousands. Do not let the IRS catch you off guard. I will see you in the next video.